Good afternoon, and today is Wednesday, June 17th, live from Washington, D.C. at Venable in Washington, D.C., and co-presented by Navigant Consulting. Welcome to our webinar, Managing Evolving CFPB Regulatory Risk Through Effective Change Management. My name is Jonathan Pompan, and I'm one half of today's webinar. I'm joined by Chris Sicuranza from Navigant Consulting. Chris, welcome.
Thank you, Jonathan. Good afternoon, everybody. This is Chris Sicuranza. I'm a managing director with Navigant Consulting within our financial services practice, focused on leading our banking team. I'm very excited to talk to you this afternoon about managing CFPB regulatory compliance through effective change management.
And Chris, as you know, and folks on the line, thank you for joining us today. I'm a partner and co-chair of the Consumer Financial Protection Bureau Task Force here at Venable. And my practice involves a variety of work on the compliance and enforcement sides related to the CFPB, Federal Trade Commission, and States Attorneys General and banking departments for a wide variety of non-bank and bank financial consumer service clients, as well as their service providers, which frequently also get brought into the mix. So the rapid pace of regulatory change and expectations, coupled with oversight through supervisory exams and investigations, as well as enforcement actions, are forcing banks and financial services companies to evolve their compliance management systems. Whether it's for CFPB examination preparedness or post-settlement consent order compliance or something in between, effective regulatory change management is critical to managing regulatory risk. During today's webinar, Chris and I are going to share our experiences from the front lines and offer strategies to help you navigate the evolving legal landscape, as well as also what we know has been a challenging set of work over the last 4 to 5 years internally within companies and particularly within compliance departments. Our webinar today will be recorded and is available for listening and viewing on the internet afterwards. We'll be sending announcements about that later. Today's webinar, of course, is going to be a discussion. It's not going to be a lecture, and we're not going to go through every particular CFPB announcement for the last 6 months or even last 4 years, or cover information you can read online on our website or Navigant's website or even the CFPB. Rather, what we want to do is have an interactive discussion. Chris and I have been talking now on and off for over 3 years, as well as his colleague John Stark and I. So what we'd rather do is kind of invite you into that conversation, and for folks that have questions or any other sorts of questions at all, please feel free to log in and use the prompts on your screen. In addition, later today, we will also open it up for additional questions, but please feel free to present questions at any time during the course of today's session. We can see the chat feature on our screen on our side, and we'll be happy to work those in as the conversation proceeds. So please follow those on-screen prompts, and we'll do our best to incorporate them all into the conversation. Now, of course, also one last sort of housekeeping item, and that is today's presentation is purely Chris and my own comments and opinions. This does not represent the opinions of Navigant Consulting, Venable LLP, or our clients. Certainly not of any of the attendees today as well, although we do hope you might share your experiences through the chat feature that we can share with other people too. But please don't send us any confidential information or specific questions that relate directly to your business, because we're not going to be able to focus directly on those today, but certainly Chris and I are going to be available afterwards, and please feel free to email us at any time. So, and lastly, for folks that are online and are attorneys and looking for CLE credit, you're going to be able to, in certain states, get 1 credit hour as described here on the screen. And for those of you who are old pros at this, you know there's a code that's needed for that and a certificate. That process will be handled after the fact. We'll send out an email, and then you can follow those prompts to qualify for the CLE. In order to do that, though, you'll need the code, and we'll provide that code at the very end of the session after the Q&A and the wrap-up. So now, Chris, the genesis of this session was a number of conversations between yourself and John Stark on your side about sort of what we're seeing in the marketplace and how things have changed in the last 4 years. It used to be that either you or I or any of the other practitioners out there and many of the folks that are online that are in-house have been presenting sort of CMS decks for years. at this point, and particularly at banks or old pros at that. For some folks in the non-banking world, a little bit new language, but oftentimes there's, of course, a compliance function, a legal function involved at most organizations already, pre-CFPB. But, all that vocabulary changed. We've been noticing that stuff is essentially becoming a bit stale because it's sort of been there, done that. And also to the regulatory environment has moved well beyond just looking at CMS. And most companies, to the extent that they needed to, have enhanced those CMSs. It's now, people are faced with all these regulations, expectations through bulletins and other announcements, and trying to make sense of it. What's your take on sort of where folks are now between 4 years ago and today?
Thank you, Jonathan. So, yeah, as you mentioned, the pace of regulatory change has just been considerable in the past few years. And we see folks within the industry really trying to manage and really deal with that change. And, what we'll talk about today is really how folks have been able to implement processes and approaches to really manage that change and maintain and demonstrate regulatory compliance over time. One of the things we always talk about, Jonathan, is every day there's something new that comes out, whether it's a new enforcement action or a pronouncement. Just this morning, the OCC amended some of their mortgage banking consent orders, so that the pace of change has just been very intense. Can you help place it all in context for the folks on the phone?
Yeah, absolutely. I mean, what we're finding, I think, is that the regulatory change has gotten to the point now where there's a lot of sources that folks are looking at. And, if you just sort of look at the evolution of the CFPB in the last year, and even over the last 4 years, essentially, with its birthday coming up in July, it's projected that the CFPB is going to have over 1,600 employees on a full-time basis by essentially the end of September and beginning of October. Supervision, enforcement, and fair lending is going to be 747 of those full-time employees. Not too shabby when you consider that's almost half, and there's a good chunk of folks that are in admin and other sort of support functions that are not core to that mission. And then when you look at the budget too, I think this puts it into context. You've got a budget here of over $170 million being spent on supervision, enforcement, and fair lending. That's not even the entire budget of the CFPB, but not an insignificant amount of money. And certainly for folks that are attending today, I'm sure you've all read, there's essentially no limits to the amount of money that the CFPB can tap into. As a practical matter, they do have budgets, and there is some checks and balances on what can be spent, we understand. But overall, 171 is probably just a drop in the bucket. If they need a little bit more, I'm sure they could get it, and they're not subject to federal appropriations process, so they don't have to answer to Congress for that.
With that many people, Jonathan, where are they focusing? I mean, it's a lot of people to have out in the field doing examinations, writing pronouncements. If I'm somebody in the lending space, where should I be thinking the CFPB is going to be asking me about next?
Yeah, that's a great question, and one where I would like to conveniently just say everywhere and everything, but we know that's not very useful. The CFPB's focus, is probably best thought of in three broad buckets, and then there's some sub-buckets too. And in the three broad buckets, I'd say, are certainly the mortgage rulemaking. And most folks on the line who are part of the mortgage industry, which I think about a third of our attendees are today, well know that there's upcoming changes in the mortgage world that have been in the works since the passage of Dodd-Frank, and to some extent even before that. Those changes have occupied quite a bit of intellectual as well as also just physical person power at the CFPB in the regulatory relations group. And so in the supervision shop and in the regulations shop, that has been something that has been a primary focus. And it makes sense. There were statutory deadlines and very specific requirements that had to be implemented, and as a result of that, it just has a cascading effect. And one of my new colleagues, Andy Arculin, has come over from the mortgage shop at the CFPB, and there's certainly not like a week that goes by where he's not already speaking publicly on that topic and essentially filling the same slot he used to fill for the CFPB. Second bucket is areas outside of mortgage, particularly areas such as debt collection and others where the CFPB has focused their attention where consumers don't have a choice. The Richard Cordray and others at the CFPB will often talk about debt traps, where consumers aren't necessarily opting in, but they are particularly focused on areas where the consumers do not have the ability to choose their service provider. They haven't purchased the service. It's something that's either happening on the back end or as an incidental aspect of it. And debt collection is a great example. We'll talk a little bit more about that later. But debt collection is one of those things where actually almost every business engages in it, and for the CFPB, it oftentimes is low-hanging fruit. You also have in the sort of the third bucket, I'd categorize just flat-out deceptive practices or unfair or abusive practices. Facial advertising, misleading statements, whether it be for credit card marketing or mortgage foreclosure relief. There's a whole swath of enforcement activity and supervision activity focused on areas of facial advertising. And what I mean by that is simply somebody who says one thing and then does something else. And that's an area that the Federal Trade Commission and their financial practices group remains active in too.
Great, Jonathan. That makes a lot of sense. And so where are they? Where are you seeing the enforcement actions? Where are you seeing the rulemaking occur?
Yeah, the rulemakings are interesting. So on the rulemaking side, the CFPB has really only completed what I'd say two categories of rulemaking: mortgage, and even that, from an implementation standpoint, has yet to fully occur. So it's going to occur later this summer. And there is a scenario, too, where there's a bunch of companies who are still working to get into compliance with what those rules are going to be. And then there's a whole swath of rules that are still in progress. They've either been announced or we know they're coming down the pike, but they're still at the non-final stages. A great example of that is the payday rule proposal for small dollar lenders. Payday lenders and others are going to be likely impacted dramatically by what the final rule is. But that's years in the making. Right now, you've got just a proposal that's out there. Now, the writing's on the wall in terms of what a lot of those requirements that the CFPB is looking at, but we're still at least 2 to 3 years out from what a final rule is going to be. And so in that marketplace, for instance, there's a lot of pressure being put on companies through the enforcement and supervision mechanism well before there is a final rule. In the prepaid market, for instance, there's a notice of proposed rulemaking that's out there. But again, still not final. And then there's proposals to amend various mortgage servicing rules that took effect a couple months ago. Those rules, again, likely to be a bit in flux for the next couple of years, and there's certainly going to be efforts on the part of industry, I think, to revise or at least help suggest ways that implementation may be done in a different manner. And so that shakeout period is still going to be there. And then you've got other areas, too, like debt collection, where there's a advance notice of proposed rulemaking that was issued over a year and a half ago, November 2014, and it looks like there won't be another announcement until December at the earliest in that sector.
What do you recommend folks do in that in-between time where something is put out to draft and it's not an official pronouncement? Should folks take action at that point?
Yeah, I think there's it's challenging. I think it's market specific. I think sometimes it's company specific. But there's a lot of other places for tea leaves. Like, so for instance, there's several reports and other publications that are out there on all sorts of topics, and some of those are market specific. So I don't think one can just look at the regulatory rulemaking announcements to understand what the CFPB's expectations are. I think frequently one has to incorporate both the reporting that's out there, although there is an aspect of an echo chamber with those reports, and then also, of course, bulletins that the CFPB has released, and then importantly, too, and I hope we get to touch on this later, the supervisory highlights that the CFPB is putting out, which are literally field notes from their supervision examinations. In some cases, They're heavily genericized. In no case do they represent a specific company facts. They don't name actual companies, but they do provide a really good indication of the level of, in some cases, granularity that the CFPB is looking at out in the field. And in those situations, for any company, one has to sort of look at all of that entire panoply of material and information to get a really good sense of what the lay of the land is, and then match that up to their own company's risk tolerance and, significantly for the CFPB's perspective, consumer risk. So the CFPB could care less if it's going to cost money or decrease sales or revenue, as long as it addresses mitigating consumer harm. And that's a very different risk analysis than what historically many institutions have engaged in when doing risk analyses.
Absolutely. It's one of the things, Jonathan, when we talk about regulatory change management, we feel it's a very important factor is actually to come up with a risk rating, and a risk rating from the perspective of not just the financial impact to the firm you're talking about, but also the potential impact to the company's customers, whether they're borrowers or what have you. And that's an important aspect of what we believe is a part of the regulatory change management process. Jonathan, one of the things we've talked about quite a bit is the general trends. One of the things you often comment on that has really caught my attention is the impact of supervision and how that impacts internal compliance steps.
Yeah, it's right. The supervision's interesting, particularly for non-banks. It's a new world for non-banks that were not typically supervised on the federal level and therefore subject to examinations. And in some markets, the entire compliance model is built around essentially was the absence of the examinations and uniform rules, whether that be debt collection or in some other areas that have been traditionally historically governed either by a general federal statute and a bunch of state laws, as well as a lot of court decisions. You've got a scenario now where the CFPB is coming in and imposing sort of the lowest common denominator, pro-consumer, of course, across the board in scenarios where there may have been arguments that the law was not what the CFPB believes it is today. And folks will differ on that, and there may be litigation around some of those topics in multiple verticals. But what we're seeing, though, is that in the supervisory context, in the report of examination situation, it's really forcing individual companies to make determinations as to whether or not they want to challenge what the CFPB's viewpoint is on a particular issue, issue by issue, company by company, and given their own specific context. And it's, in some cases, not for the industry to fight anymore. So what used to be industry-wide efforts to push the law in a particular direction or to push for uniformity, it's now coming from the CFPB, and they're imposing that specifically on companies. And so there becomes oftentimes a decision point in the course of a supervisory exam. Should a company appeal a finding that it believes is either factually inaccurate or, more importantly, that the law was not what the CFPB believes it is, that there's an interpretation issue. And that poses a decision that frequently non-bank organizations have not traditionally had to make. Banks are oftentimes very much in tune with that process, and our finding has been that in the last 3 years, non-banks have had to come to grips with that. And we've had a lot of success in the appellate process at the CFPB. It's not one that's often talked about. It's all confidential, but there are companies that do appeal exam findings and do find that the CFPB will acknowledge an error or a change. But that's a long road to travel, and there are ways to avoid going down that road on the front end in an ideal situation.
Absolutely. So you have seen people have success with the appellate process?
We have. And now the CFPB does not tend to update its supervisory highlights, so I can say that in at least one instance I know they've highlighted something that ultimately became a different outcome. But there is the ability to appeal, and there is at least, I can say anecdotally, some ability to have success there. They do have the home court advantage, And as we saw recently in the PHH appeal of a administrative proceeding, which is a little different, but the home court advantage does have its advantages for the CFPB, where ultimately the judge, jury, and potentially the executioner, in that case the collector, I think they upped the civil money penalty considerably in that case, even after the administrative law judge had determined it should be something lower. And so the appeals process is slightly different than that. And I think ultimately what is significant in the appeals process is it does allow for at least a different set of eyes to be placed upon legal interpretation and facts outside of the specific examiners and the examiner in charge of a supervisory exam.
That's helpful. Thank you, Jonathan. I know a lot of folks would be really interested in that process. And so, one of the things we talk about quite a bit, Jonathan, at Navigant and with you is, there seems to be endless sources of guidance and expectations, not to mention laws and regulation. You have the states, you have the different, regulatory agencies. What are the drivers of all this, guidance and expectation?
Yeah, I think it's unique because it depends on the market, as I mentioned earlier. But you've got a scenario where there's a lot of different sources of information that needs to be aggregated by either the compliance committee of an organization ultimately, but there needs to be some ability to get that information to the compliance committee. So I know we've got a lot of folks attending today that are in compliance departments, and it's a constant effort, I'm sure, to aggregate the information. And certainly, there's no shortage of folks pushing out information too, whether it be law firms or consulting firms, trade publications, et cetera. There's all sorts of analysis and as well as raw material. But I think the raw material is first and foremost the most significant. Starting with the individual company and their consumer complaint history, which is its own unique realm.
An area that's getting a lot of attention, right?
A lot of attention. It's driving supervision and enforcement prioritization within the CFPB. It's also one, too, where on an individual basis, the CFPB has been pushing for certain results in the follow-up to the first round of responding to a complaint. So typically, companies are given the opportunity to respond to the complaint on the first round in relatively a benign manner. It's sort of mostly automated. But the second round, if the consumer or the CFPB is not satisfied with the response, tends to end up being one where there's an individual at the CFPB assigned to follow up on the original response. And oftentimes implicit in that is the concept that the response wasn't satisfactory, the outcome wasn't adequate. And depending on the market and depending on the company, that can be, those numbers can be high just in terms of statistics, but also just the outcome can be dramatically different and have consequences for changing policy just as a result of the complaint history. And that's something that's, I think, that story has not really been told yet, but I know companies are facing that. And the complaint responses need to be synced with overall compliance, as well as also the funnel for deciding whether or not to do change management internally. Yeah. It's very significant, and not just what the company's view of a complaint is, but also what the CFPB's view is. But of course, there's also the examination manual, the supervisory highlights, no shortage of enforcement examples in a lot of different markets, and then, of course, the regulations as well. One thing I would note is it's not always intuitive whether or not something's going to be relevant. We saw even today there's an enforcement announcement related to service members, auto loans, and debt collection. So at least at a minimum, those three topics may be relevant to anyone in either of any of those markets. And then on top of that, I would suggest that anyone who's working with service members, lending, or has a debt collection function would find that relevant, even though it was really fact-specific and a unique lending program. So supervisory highlights tend to lump things, and the enforcement actions tend to lump things in particular categories with particular labels. But I do suggest, and certainly we look twice, sometimes more, at the individual results that the CFPB is pushing out, because there's oftentimes, by analogy, good tea leaves.
Absolutely. And the impact of having multiple agencies regulating, the industry, what does that, result in?
Yeah, it's not easy. So, here we've got the, now I think becoming famous Venable Pac-Man logo. We can't take credit for that, but ultimately the CFPB is using UDAP to gobble up everything. So, in effect, they're bringing in the rules, expectations, concerns of other government agencies and finding a way to go after that from a pro-consumer standpoint. But that should not at all take away from other government agencies and what their powers are and their individual activities. So the Department of Justice, for instance, has been very active in doing what is well known now, Operation Choke Point, which is going after key service providers that they think can essentially choke off the oxygen from industries and particular companies that they believe are causing consumer harm. Most notably, payment processing is essentially an essential function for virtually every business, particularly in the small dollar lending area. There's been a lot of focus by Justice going after either banks or the processors in conjunction, in some cases, arguably with the CFPB and FTC and others and within working groups to place pressure on the processors to withhold the processing of what otherwise would be viewed legitimate payments to particular companies and within whole categories of what they viewed as high-risk areas. Definitely controversial, getting a lot of attention on Capitol Hill, but from a legal compliance standpoint, causing stresses on compliance departments, risk departments, should we work with particular companies in particular spaces. And then as a collateral consequence, if you're affected by that, you may face deselection. It becomes a business issue too. So that's just one aspect of a good example of how you've got the Department of Justice pushing as well as prodding in a particular area that's having a collateral impact. Federal Trade Commission is still very active in regulating and bringing enforcement actions in the financial practices sector. And then, of course, in particular verticals, whether it be like the Department of Education, their efforts related to student loans, match up and complement the CFPB's work, as well as the FTC and others.
How much is coordinated there between the agencies? Have you seen?
I think there's a fair degree of coordination at this point. They're certainly much more coordinated than they've ever been before, and there is task force and working groups that have been put in place where they do exchange notes and information. And that's even happening not just on the policy level, but for specific companies and examinations. For instance, the CFPB is coordinating with state examiners, and so it's not unusual now for companies to be examined by specific state regulators at the same time as being examined by the CFPB. We've seen that in debt collection and in other markets. And so what that means is maybe some efficiencies, but it can be also a lot to manage. And the list goes on in terms of how other government agencies are playing into this. But again, got to take it all into account now.
And so from a compliance management system perspective, we've talked about maybe highlight some of the roles and the benefits, and then we can talk about how regulatory change management plays into an overall compliance management system.
Yeah, I think the compliance management system discussion, as I said earlier, has really changed in the last 4 years. It's no longer a new vocabulary word for the non-bank world, and in many cases there were already systems in place, but perhaps not exactly to this sort of the spec of with CFPB or the spec of really a federal banking regulator. Most organizations have had compliance functions and can't function without it. In some cases, some organizations have been a creature of law. Their products are heavily regulated. But again, it was done in a different way. And when one's faced with supervision and a constant possibility of oversight and review, where in compliance management, there's oftentimes the vocabulary term, 3 lines of defense. Well, there's also the first look that an examiner does, and that first look is always what's going on here in terms of compliance. It's the first question they always ask, and they want to understand the structure. And then they get into the details. And so oftentimes organizations in the non-bank space would have been well focused on the details, but perhaps not as focused as much on the structure.
That makes sense.
So, Chris, what we've seen is, obviously a shifting regulatory landscape. I've mentioned a little bit of our perspective. From your perspective, have you seen the same?
Yeah, absolutely, Jonathan. And so, we believe a key function of the compliance management system is having, the ability to operationalize the regulatory change. And so a well-developed regulatory change management process is designed to do just that and to overcome multiple challenges. So to overcome the challenge of, ever-changing, regulatory requirements, changing state laws, the increased enforcement actions. There's, of course, costs associated with all this compliance. And so if you have an efficient, well-run regulatory change management process, you can become more efficient and effective. A lot of the banks and a lot of folks in the industry, there's been consolidation over time, and so you have multiple legacy systems from prior acquisitions that haven't fully been integrated, and so that presents a unique compliance challenge.
And Chris, on the integration side and the multiple systems, it's not just multiple systems of record for consumer accounts, which poses its own unique set of issues. But it's multiple compliance management systems, right?
Yeah, it's both of those things, absolutely. The multiple source systems pose unique issues in itself of, are you treating the clients the same way? Different processes, different procedures on those different systems. Then you have multiple compliance management systems all within the same organization. And so a good regulatory change management process, overcomes a lot of these specific challenges and allows the institution a way to demonstrate, maintain, and see compliance through all the different departments and through all the different processes. And so, over time we've recommended how to deploy that type of system to address that evolving landscape. So you can see on the slide here what we've done is we've really highlighted what we believe are the 5 key requirements to having an effective regulatory change management process. So understanding your requirements, which is a challenge in itself. As you mentioned, you've got requirements from all the different regulators. We've got requirements and different pronouncements coming out, different enforcement actions. You have state law. You have all these things that you need to be aware of. And what we found is the folks that do this the best try to capture those multiple sources into a centralized location. And by capturing it in a centralized location, you can rationalize that information to understand where you have overlaps, where you have inconsistencies. Is one agency telling me something that's different than, say, something in a state, and being able to rationalize and escalate those items to legal counsel.
And is that usually a function of the compliance department or the legal department?
So one of the key elements that we've seen is important for this process is to have collaboration between all those areas, so legal, compliance, and the business. Legal is typically responsible for interpreting the law, of course, but having compliance and the business at the table is critically important, and that collaboration we found to be one of the keys to success of this process.
And so that's not just at the end of the road after a determination has been made to implement, but to understand what the options are earlier in the process. Is that right?
Yeah, absolutely. That collaboration needs to start at the beginning. And so if you take some of the recent mortgage regulations like TRID, for example, it's hundreds of pages of new regulation. So how do you take that regulation and actually operationalize it in your business? And so what we've seen folks do and what we've helped folks do is take those regulations, really understand what are the actionable portions, what part of our businesses are impacted by those. So if you take the Fair Debt Collection Practice Act, FDCPA, you have all these rules about what you can do from a collections standpoint, and you can have collections organizations within throughout your business in different departments. And so identifying which of those businesses are impacted, making sure they're at the table when you're evaluating compliance, what we call kind of linking those businesses to those regulations, and then identifying, what policies, procedures, controls that business has in place to mitigate the risk of being non-compliant with those regulations. we feel is a really important step here. And then, ultimately you need to test to prove that, hey, the procedures, the controls that we've designed are effective to mitigate the risk. And then, do some sample testing to understand, hey, are we making any phone calls, past 9 o'clock at night? Are we calling people at work? Are we doing anything that's that the regulation doesn't provide?
Yeah, and I've found too, testing, it's one thing to have an audit department, and that's the natural way to do some testing, is to send somebody out there and look at something. But what I've found, and what we certainly see in the CFPB exam situation, is they sometimes will back into essentially non-compliance from a different direction. So they'll sample calls, but what they also do is they'll sample the consumer complaints, look for the ones about calls, and then basically do a pinpoint search and identify a trend or at least a particular instance in that manner.
Absolutely.
And it's the connecting of those dots in the testing that I think is sometimes not as prevalent within organizations, simply because the first step in setting up the testing program is an audit function. That makes perfect sense, but the audit function has to pull in more than just what they're seeing on their face.
Absolutely, Jonathan. Complaints, we view complaints as almost like an early indicator of a potential problem. And so you have a complaint, and what we've worked with clients on and recommended to clients is, complaints are a potential indicator of a control break somewhere. And so understanding the root cause of a complaint and understanding, okay, we've got multiple, be able to evaluate complaints in such a way that you can determine if we have any trends or, there's a high volume of complaints in a certain area, using those complaints to really direct your audits and your testing and your compliance reviews is extremely important. And as you said, that's exactly what the examiners are doing. They're using complaints, to try to understand where there might be some smoke to see if there's any fire. And so, yeah, that's critically important to have incorporated into this process.
And for companies doing CFPB preparedness efforts, I think what's often thought of as CFPB preparedness can be daunting, because they feel as though they have to do a full-scale exam prep A to Z. But much as we just discussed, one can look at a couple key areas and then determine where there may be an additional deeper dive needed. And so you can approach it many different ways. Oftentimes with a couple coding reports and looking at some consumer complaints and a couple other things, one could pretty quickly identify a whole host of things that otherwise could take months in a linear fashion.
Yeah, absolutely. Yeah, so for exam prep, yeah, absolutely, there's a number of different things you can do quickly to identify your potential risk areas. And as you know, it's always better to know the issue before your regulator identifies it for you.
Yeah,
so
it is.
Be very
no
proactive
question
about it. And one of the things that we feel a good process like this does, it really allows you, because you've linked your controls all the way back, your business, your controls, your procedures, all the way back to the underlying regulations, you can quickly identify any areas where you might have gaps or weaknesses. And those are the areas that you want to focus on, trying to remediate. Hey, I don't have procedures around regulation I've determined to be high impact, high financial impact, high regulatory attention, high impact to our customers, that's an issue that needs to be remediated quickly. And then ultimately, you want to be able to set up a program and a process that you can maintain it over time. This is not a one-time, compliance is not a one-time thing, it's ongoing. And so having a process where you can, see these regulations come in, map them through, understand the impact, be able to make those updates quickly is extremely important. And it's a place where some folks in the industry have struggled with over time, because the change is so rapid. And so being able to maintain and communicate and sustain that compliance is absolutely critical.
Yeah, and also to the involvement of the legal function in those decisions. So, for instance, on the remediation side, bringing in legal to consult on whether or not there is a need to make a policy change, or maybe it may just be operational, right? That the solution sometimes is not necessarily a policy change. It may just be a change in implementation in the ops. The other thing that we've seen in our work is oftentimes folks just deer in the headlights, because there is not only so much to incorporate, but that the structures themselves can seem daunting, and daunting to set up, daunting to get budget approval for, to bring in full-time employees, and then doing the connections internally too, to make it all work. And I often will counsel folks that, look, take a case study, take an actual example, and run it through your system, or explain how it was run through the system, and identify or confirm that there's no gaps within your CMS simply because of a particular issue that you actually dealt with.
Yeah.
And ideally there shouldn't be any, but sometimes it's those connections. You find out that you had a connection that you actually maybe didn't need, and it turns out that there was a committee meeting that never happened that maybe needed to. I'm sure there's no shortage of to-do lists within organizations, but oftentimes that's creating something new rather than confirming that what you do have can work. And certainly in the non-bank space, what we've also seen is that there's no shortage of companies that have plenty of systems in place. They just don't use vocabulary that the CFPB is familiar with.
Right.
They don't necessarily call it a compliance committee or have a standardized process in place. And so what may be done perfectly well ad hoc to address real, true legal and regulatory compliance issues isn't documented.
So Jonathan, aren't you saying, I think we're seeing a lot in our space that the expectation is that you can demonstrate compliance, that compliance is not something that's just happening by accident, but you can actually prove it. And having a well-functioning regulatory change management process allows you to demonstrate that compliance by being able to show that, hey, we have procedures that show that we follow the SCRA. We have controls, whether they're automated controls or systemic controls, that doesn't allow our auto dialer to make phone calls after 9 o'clock at night. And so we're seeing more and more frequently that the regulators are expecting you to be able to demonstrate that compliance and not for it to be happening by accident. Are you seeing the same thing?
Yeah, absolutely. And it helps with the strategy, and it helps with the overall story that a company will want to tell, whether it be in an investigation or an examination situation. The reality is very rarely is there absolute perfection in practices for a variety of reasons. But if one can explain that it was an anomaly and that there was a system in place that, for whatever reason, might not have addressed it, but can adapt and be critically used to address it and otherwise was in place, and everybody had reasonable intent behind all the structures that were in place and the ability to show that there's spatial compliance with all the basics, that can be the difference between, potentially a closing letter or a slap on the wrist versus a full-scale enforcement action where the CFPB brings out everything and then some, and doesn't give a company a chance to even negotiate either a behind-the-scenes settlement or a public settlement, and goes right for the jugular and files a lawsuit. And there's certainly examples in the marketplace where the CFPB has taken very aggressive action, in some cases to make examples, and others because there simply wasn't the apparatus in place, and I suppose, this speculation on my part, they didn't feel there could be either. Mm-hmm. And that's critically important. And the more process that's in place on the front end, the easier it is even for the CFPB to do their on-the-ground job too when they're doing the exams. And the reality is nobody wants an examination that's going to be 12 weeks or more of folks on the ground disrupting a business. And oftentimes clients will say, how can we make it go faster? And so if it's organized and folks can find what they're looking for, it goes faster.
Absolutely. So Jonathan, one of the the kind of 5 things we think are pretty important to having an effective framework is really what's up on the slides here. So we talked about understanding the requirements and the rules that govern the particular business you're in. So that provides the foundation for compliance. Understanding what laws you're supposed to obey as you do certain activities. Without that understanding, it's pretty difficult. And then being able to take those regulations and pronouncements and tracing those through, what businesses are impacted, what procedures are impacted, what controls do you have in place to, mitigate the highest risk items for yourself. And then, exactly like we said, provide that transparency for senior management and for the regulators. So be able to show them that we have processes and testing programs in place. We manage our complaints. We know how many complaint volumes are. We root cause our complaints. And so provide that transparency to management and the regulators to demonstrate that we are managing and maintaining compliance with what's important. We talked about collaboration, having legal, compliance, the business, risk all at the table, during these discussions, during the implementation of a new regulation, during the change of a regulation. And then ultimately, the whole process needs to be maintained. And then the people who actually run the business need to know about it. And so you need to have communication to the folks that are actually doing the work.
Yeah, we've seen that actually in exam situations and even in some cases in investigations with investigational hearings, essentially depositions of particular individuals within companies where they may know their area, but they don't know what happens before or after, or really what the context is for the instructions they were given to implement.
And those handoffs are where you have the biggest regulatory issues. When things get handed off from one group to another, everybody does their thing pretty well in their own area, but those handoffs are where you have the biggest risk.
Sure. I mean, for instance, in the debt collection situation, if you have a litigation shop and also just a general collections lettering and phone call shop, the decision-making that gets done for why an account gets placed in one channel to another is often done well before the account gets to any of those particular channels. And so the person in the litigation shop is not going to know why the account got to them. And that oftentimes is what the CFPB may be interested in, even though they say they're interested in, quote, litigation. Let's use that as an example. Or in the underwriting situation with a loan, again, what type of underwriting is being done? Oftentimes, that's done well before those metrics and the coding and everything like that is done well before an individual underwriter attacks a file. And in some cases, it's the computer.
Yep.
So and that stuff may not even be documented. It may simply be computer code.
Yep. Bankruptcy is another big area where that type of thing happens. Bankruptcy credit reporting, as you know, is another one where the systems are potentially generating things that aren't appropriate.
So this is a reminder for folks that are attending that please feel free to send in questions for Chris and myself. Happy to take them, and we'll be coming up on a defined Q&A period. But certainly, if there's questions now, please feel free to send them in. We've got a couple queuing up. So, Chris, there's a lot of key challenges and opportunities identified through implementing the regulatory change management process. Our attendees are living those challenges each and every day. We only see the tip of the iceberg usually. From your perspective, though, oftentimes you're out in the field likely for a little bit longer than the lawyers are involved, because oftentimes you're involved in either the remediation or the cleanup process, what's happening after somebody agrees to do something. What are you seeing as opportunities in hindsight that companies should take advantage of?
Yeah, so Jonathan, like you said earlier, the real challenge here is cost and complexity. There's a lot to bite off and chew, and so if you try to do it all at once, it can be quite difficult. And so the folks that I think have been most successful have been very focused on the areas they want to tackle. But from an opportunities perspective, I think there's a number of different big opportunities here. Number one is the ability to better demonstrate and be transparent on your compliance activities. The second thing is the information you can get out of a well-done process here can show you where you have overlaps between businesses, where you have multiple collection functions. Are they doing things the same way? Are they doing them differently? You're getting complaints in from multiple channels. You're getting escalated complaints. You're getting complaints through your call center. You're getting complaints from the regulators. Are you bringing those complaints into a centralized location and evaluating those together to do root cause analysis? So you have a whole host of opportunities by centralizing a lot of this information to really get some benefit and some value out of it. Another thing we see come up is something like SCRA cuts across all your different business areas. Having the ability to say, from a senior management perspective, I know we're abiding by SCRA in mortgage and credit card and auto lending. That's got to give management some level of comfort for something so high risk. Again, it allows you to manage towards the riskiest areas when you understand what are your highest impacts and put against your controls and against those higher impacts.
Chris, one of the things we've also seen is scenarios where sometimes the CFPB is looking at some of the stuff that's just most facially obvious. So the advertising and marketing pieces of whatever the product might be. It could be a credit card. It may be some other form of loan. It could be even on the debt collection side, it's not advertising per se, but just the facial lettering that's going out to consumers and what it says, what it may imply. The scenarios that we've seen is one where oftentimes if just a fresh set of eyes can really lend a lot of help to an organization, and that stuff might not be captured solely just by the compliance management function. The question is sort of who's responsible for vetting things and what's that process in place. I know historically too, there's always challenges internally within companies about where's the budget for legal review and compliance coming from, and that oftentimes presents its own challenge.
Absolutely.
Just a reminder for folks that we'll be giving the CLE code at the top of the hour at the conclusion of the webinar. But first, Chris, the change management process provides a lot of benefits. Certainly the most obvious is it presents a reduction of risk. But for consumers, the customers, and the other stakeholders, it can also be useful. Even in public policy debates, the ability to demonstrate compliance is usually sort of the threshold question we would say to a client before they go off to push a particular policy objective. What are you seeing on the ground? You've got oftentimes teams of folks within organizations doing reviews, oftentimes fancy algorithms, charts, databases to help folks construct the compliance management system. But what are some of the things that folks might not be thinking of?
That's a good question, Jonathan. So one of the things that we've seen is just a much greater focus on the customer and the customer's experience. So if you have a happy customer and a customer is satisfied, they're going to come back and continue to do business with you. So the more you can evolve your business to treat the customer fairly, give the customer opportunity to have their complaint heard and remediated, the much better shape you're going to be in over time. Again, this process we feel allows you to really build some efficiencies. What's happened over time, Jonathan, I'm sure you've seen this, is because there's so many different regulations, people have put patchwork of controls and procedures in place. And the controls are overlapping.
That may be an understatement.
And so there's a really good opportunity to go in and say, God, we've got all these controls in place. We've got these gigantic organizations doing all this testing. Like, do we really even need all this stuff anymore? And so being able to rationalize those processes, rationalize those controls is, I think, a tremendous opportunity for folks out in the industry. And that'll help with efficiency, that'll help with cost, and that'll help reduce some of the burden of the environment we're in.
Yeah, the overlap, or in some cases the gaps, are always interesting. You've used debt collection earlier. Whether it's a bank, a debt collector, jewelry store, a student loan lender, there's a private sector college or school. You will have a debt collection function somewhere, and it's one of those things that the CFPB has been really focused on. It almost doesn't matter which category of business it is; they seem to go right for that area. In part because for a lot of businesses, as much as receivables are important, it's not the core focus, despite what the CFPB might think. Usually it's providing college courses or the actual jewelry, just to use those two examples, or the car, not the loan. But the CFPB is focused on those areas, which I think anecdotally certainly shows that there's a ability for the CFPB to recognize where weakness may be. in any one particular organization or within particular markets. And with auto lending now coming online for full examinations of the larger participants in that market, which is essentially as defined by the CFPB, every participant almost, that's a whole nother area where they're going to be focused not just on the loans themselves, but the debt collection function. You see that also in with large banks. They review credit card lending practices, for instance, and credit card advertising and marketing practices very early on. The CFPB picked up some of those enforcement actions from some other institutions during its first year and made some pretty big announcements related to that. But now they're moving into doing exams of other functions related to the advertising practices, as well as everything up until and through collections. And of course, collectors themselves are under scrutiny. You see that too even in the lending space as well. With the small dollar lenders, a lot of those enforcement actions that have been announced have been debt collections. So just to use that as one example for folks in the audience, the core business, the core compliance functions, the requirements that everybody knows and lives by within a company, oftentimes have been done just fine. And that's not necessarily always where the CFPB is finding the issues, though. So the ability to identify the gaps or the underserved areas within a company, I think, is oftentimes key. Well, for folks that are attending, we're coming up on the end. We've got a question here, non-compliance management getting regulatory change fatigue. How does one sort of collect data to demonstrate efficiency and effectiveness of a compliance department? I mean, if you have, let's say a $50 billion business, there's a lot of data to collect, a lot of evidence that you'd want to produce or sift through. What's the best way, Chris, to demonstrate compliance in that situation? Let's assume there's policies and procedures for every function, but how do you get to demonstrating the practices are in play?
Yeah, so I think that's a great question, and so I think it goes back to some of the items we've talked about earlier, and that's are we getting a large number of complaints? Are auditors finding issues? Are the regulators finding issues? When we do testing, are we finding issues? Having a well-designed system is important, but then in the execution is also just as important. So I think it goes back to some of the things we've talked about earlier around kind of testing, design, as well as effectiveness, and then managing complaints as an early indicator of potential issues.
Yeah, and I think too, the size of the company is important, but what I'm also finding is that what you've got is scenarios where the size and even internal, the number of people in a compliance department or legal department doesn't always seem to be the leading indicator of being able to demonstrate compliance. I think to be able to efficiently do that, it's being able to tell the compliance story, no matter how big or small the organization, up front when first engaging with the CFPB. And so at this point, there's a lot of companies out there that have what we'll call a relationship, in quotes, with the CFPB, whether it's because they've already had a first-round examination or they're active in public policy efforts. But not every company does. And if you haven't been through it yet, not only getting prepared internally, but understanding what the, for lack of a better term, is the story is of the company in the compliance functions, and being able to show some stuff qualitatively and quantitatively, proactively, in addition to the document and information requests that the CFPB will make, can go a long way to structuring that review, and if not steering them in a particular direction, at least being able to demonstrate to them that you've given it conscious thought and the ability to also adapt if necessary. And I think that becomes extremely important, particularly now that we're getting into first-round exams of a lot of the non-bank areas, particularly even, for instance, in the auto lending space, where there was a lot of push early on fair lending and other inquiries that the CFPB and the Justice Department have done. Certainly there's been a lot of press and news about that in the trades and elsewhere. But now we're getting into nitty-gritty aspects of compliance reviews, and the ability for someone to not just take a defensive position, but to take a proactive position, to be able to proactively say, this is what we do to comply, whether or not you've asked for it or not, which they will have asked for it. But to package that up throughout an exam process, not just when they're on site, but also afterwards too, and then to proactively engage. So it looks like we've now hit our time limit, and I'd like to thank all of the attendees today. We've had a great audience, and please stay tuned for the CLE code. But first, just a reminder, we'll send out information about our webinar shortly, including a copy of the slides. And if anybody wants to access a recording to this presentation or share it with friends or colleagues, please feel free to do so. There's going to be a link to the presentation in the email that we'll send out to attendees. And of course, there'll be information available on our website, venable.com, CFPB/publications, and Navigant's website, navigant.com. The presentations are, of course, going to be available later this week, along with the recording, as a reminder. I'd also like to thank Chris Sicuranza today, and everybody at Navigant Consulting, John Stark particularly, and Lil Alejandra for helping organize this session. All the folks here on our team, Camille King and many others, for pulling this all together. We certainly can't do that all ourselves, and we appreciate the help both on the technical as well as in some cases the substance. And so everybody involved here would like to thank the attendees. So you've been listening to Managing Evolving CFPB Regulatory Risk through Effective Change Management.